Hello everyone. So our topic is expanding multi-regression dynamic model framework for stock prediction and portfolio selection. Basically, we will be using and assessing the performance of graphical models for predicting stock returns and creating stock portfolios. The goal, which is like very popular among investors and finance professionals, which is to basically create a diversified portfolio that minimizes risk and maximizes returns, which is something very natural. So we use graphical models so that we can capture the time varying patterns in the correlations and covariances of the stocks and reflect the cross series dynamics at multiple time indices. So the data which we consider is basically sector wise. So we consider sectors like IT, finance, and energy. And within these sectors, the stocks are quite correlated. So it might be interesting to see how this works out.
We utilize a variety of graphical models, which are shown here, and we're going to explain in detail of each model in the following slides.
We use PCA to dimensionally reduce the stock returns and select portfolios and use it in a rebalance simulation. And this was a baseline comparison. And then the training data was daily return data for 1 year, and we fit it to 3 PCA components. And we calculated the L2 norm of the original data and the reconstructed data for each stock. And the max difference portfolio was the top 10 stocks with the max L2 norm, and the min difference was the 10 stocks with the minimum L2 norm. And then we used the following year for simulation, and the rebalance strategy was to evenly weight the portfolio across 10 stocks every month. And so these are some of the results. So for 2014, this is the simulation year, and the training data was from the year 2013, and et cetera. And you can see the max difference portfolio outperformed the min difference portfolio and the S&P 500, and it also has higher volatility. And this is true for these 2 years, also 2016, 2017, and 2018. And here we summarize the data. And the standard deviation here is the standard deviation of daily returns for that portfolio in that simulation year. And you can think of it as a proxy for volatility or risk. And the max difference portfolio had higher returns and higher standard deviations than the min portfolio or the S&P. And so this strategy can be used to select portfolios with higher returns and higher risk. And the reason why it worked was because PCA was not able to capture some of the unusual behavior of some of the stocks. And so we put those stocks into the max difference portfolio. And we also use variational autoencoder, and we use the same data, the same portfolio selection and rebalance strategy as PCA simulations. And we tested 2 autoencoders. The variational distribution Q was distributed as normal for both. And then P of the likelihood P of X given Z was Cauchy for one of them, and then it was normal for the other. So here X is the observed stock returns and Z is the latent space. And we use Cauchy and normal because we wanted to compare them, and because finance data has often shown to have heavy tail distributions. And so we train these autoencoders with auto-encoding variational Bayes until convergence of the lower bound log likelihood, and we calculate the L2 norm of the difference between latent space representation of the data and the latent space representation of the reconstructed data for each stock. And then the training with the simulations was repeated 10 times each. And so here we show the latent space representation of the Cauchy autoencoder, and the latent space was chosen to be 2 dimensions. And you see that there are very distinct clusters of the different sectors, tech, energy, and finance. And the Cauchy autoencoder did the best at separating these clusters compared with the PCA or the normal autoencoder. And it shows that the autoencoder did learn useful information, and only given the stock returns, it was able to separate these clusters. So we thought that was quite remarkable. And it could also show that the sectors are correlated within the sector. And so these are the results from the simulation. And each of these numbers here is a mean of the 10 different repeated trials. And then we also did the hypothesis test of the max portfolio and the min portfolio having the same returns, being the null hypothesis, or having the same standard deviations as a null hypothesis. And so a lot of these values are small, meaning that we would reject that hypothesis. And then in general, we see the max difference portfolio having higher returns than the min difference portfolio for most of the cases. And it is also easier to see that for the Cauchy autoencoder compared to the normal autoencoder. So it shows that the Cauchy distribution did make a difference, and it has more realistic representation of the finance data. And then we also see there are some cases where the max portfolio did not perform as well as the min difference portfolio, and this is not as consistent as PCA. So we think that it could be because the autoencoder is more complex nonlinear representation. And for both autoencoders and PCA, there was a large basket of non-overlapping stocks that would be selected for the min difference portfolio. And then for the max difference portfolio, there would be some stocks that would be appearing across the 3 models. And so these strategies do allow us to select portfolios that have higher returns, and they might also have higher risk.
Now we move on to dynamic clustering. Here we want to capture the time-varying behavior of covariance matrices by dynamically constructing clusters on a quarterly basis. The outcome of dynamic clustering is a block of graphical sequences. We employed 2 clustering methods. One is agglomerative clustering, where we need to provide the number of predetermined clusters. The other one is affinity propagation clustering, where the number of clusters is not an input. Before using any clustering method, we need to construct the covariance matrices. Here we use quarterly returns to calculate covariance matrices. We also use graphical lasso to determine edge connectivities. So for agglomerative clustering, we need to determine the number of clusters a priori. We use the full data set to determine the number of clusters by creating a dendrogram. The dendrogram was calculated by using Ward's minimum variance method. On the dendrogram, we drew a horizontal line and count the number of clusters that lie below the horizontal line. Here we found a total of 15 clusters. As for affinity propagation, here is a very brief introduction to the algorithm. Given a data set, we want to quantify the similarity between any pair of any 2 points, such that the similarity of one pair is greater than the other one if and only if the point is similar to J than to K. We use 2 matrices, responsibility matrix and availability matrix. Those 2 matrices are updated alternatively throughout the steps. And at the end, we find the cluster center by using the equation shown there. The points from the final, the diagonal points from the final matrices are used to calculate the final cluster centers. Here is a visualization of the 2 cluster method. As we can see, for most of the cases, both methods are able to identify and assign a stock to a correct cluster.
So here we discuss the rebalancing strategy. So what we want is a market neutral portfolio, and we want a market neutral portfolio because that portfolio does not have market risk, and on an average, it can be expected to be stationary. That is, it will be mean reverting. And since it is mean reverting, whenever it is on the higher levels, we can sell it, and whenever it is on the lower levels, we can buy it. So that is our idea. So every day we get clusters of stocks which we expect to be stationary. And this is done using graphical model approaches, which will be discussed later. So firstly, we obtain the clusters using some methods. Then we check if the cluster is sufficiently stationary or not using statistical co-integration test. And after that, we obtain the positions which need to be assigned to each stock to create the portfolio, right? So our portfolio can be written as the summation of the position times the price, which is the betas here in this case. And this should be approximately 0 because we want a market neutral portfolio. But there will always be some error term, which we expect to be stationary, because this is just an ordinary linear regression. So after we have done this, we keep on plotting the value of this portfolio. And since this is expected to be stationary, whenever it crosses the upper band, we sell this portfolio. And whenever we come near 0, we close out a position to realize the profit. And whenever it goes below the lower band, we buy the portfolio again, which is shown by the green dots. And we keep on repeating this process to make money. Like we sell higher and buy low, and we keep on doing this. Now the question is, how do we actually get the clusters? So one way would be to get the precision matrix of the stock returns using graphical lasso. And since graphical lasso results are the same as the precision matrix, we can do that. Then, but since the graph which we will get, it will be a fully connected graph. So we will remove 95% of the edges so that only the relevant connections are left. So basically the edges which will be left, they will show more statistically significant connections between the stocks. And we can, for example, see that these 2 blue dots and the 4 green dots are kind of fully connected subgraphs within the whole graphs. So that is what we want. And for getting that, we then further apply spectral clustering to get the clusters. And these are the results when we do the whole procedure using spectral clustering. So we can see that the PNL is quite smooth because we don't have market risk. And this is our chart for the gross position size, which is the total invested amount in dollars. And this is our net position size, which is a total net position in dollars. So we can see that the net position is very less as compared to the gross position because we are market neutral. And we see that for around $1,000 investment, we are making $120 profit in 1,000 days, which is like 12% return, which is a decent amount.
Following the previously mentioned clustering techniques, we obtain a sequence of clusters throughout the time. We use the rebalancing strategies within each cluster and calculate the profit and the loss of our portfolio. We can see from this plot that the affinity propagation in the clustering identify more clusters each quarter, therefore it leads to higher returns compared with using agglomerative clustering. Here are some other plots. The one on the left shows the gross positions. The one on the right shows the daily percentage return, which is calculated by taking the ratio of profit and loss and gross position. As we can see, affinity propagation clustering leads to higher gross position, which corresponds to higher P&L value. We also observe some spikes on the plot showing on the right, especially for agglomerative clustering. The spikes at the end section explains why the agglomerative clustering P&L value drops at the end of the training data set.
So in conclusion, the graphical models can learn real correlations between assets, which can allow investors to select higher lower variance and return portfolios. In the future, we can use additional data sets, including more years or using more features, including more features like trading volumes. We can also change the design decisions, including hyperparameters, number of stocks in the portfolio, and selection strategies. Here are some strengths and shortcomings between each graphical models. In PCA and VAE, they can both give higher return and higher variance portfolio. The VAE can be nonlinear, but it can be less consistent compared to PCA. In graphical sequences, the clusters are updated through the time horizon. They can capture time varying patterns in the covariance matrix, but it can lead to high variance and spiky returns. It can also lead to high computational complexity when the dataset is large. In hidden macro models, it can give lower return and lower variance portfolio.